Good afternoon, everyone, and welcome to our annual presentation, SEC Compliance and Disclosure Update, Hot Topics for the upcoming proxy and annual reporting season. My name is Jill Webb, and I will be the moderator for today's presentation. I'm a senior counsel in the firm's Securities and Capital Markets Department, and I regularly represent public companies in financings, securities offerings, and corporate governance matters. For those of you who may be less familiar with McGuire-Woods, we are a full-service law firm with more than 1,100 attorneys and 23 offices worldwide. Our securities and capital markets team consists of more than 50 lawyers with experience providing securities guidance and counsel to companies of all sizes, from Fortune 500 companies to smaller reporting companies. The volume and aggregate dollar work of our work and the capital market space has earned McGuire-Woods repeated recognitions among top law firms for debt and equity issuances in the Thomson Reuters and Bloomberg League tables. Before we begin today's presentation, I have a few housekeeping items to address. First, I would like to call your attention to the Q&A widget in the lower left-hand corner of your screen. Please utilize this interface to submit questions you may have for our panelists at any time during the program. We will do our best to address your questions in the time allotted, but if we do not get to them, we will certainly follow up with you via email. You will also find a number of other resources along the bottom of your screen, which you may explore during the presentation. We call your attention to the green Meeting Materials folder in particular, where you will find a copy of today's presentation slides. Okay, now let's begin. For all of us here as corporate governance professionals, the fourth quarter of the fiscal year traditionally marks the kickoff for next year's annual meeting and proxy season preparation. Schedules become very hectic as we all have our hands in the proxy preparation, 10K prep, responding to shareholder proposals, and preparing for a smooth annual meeting. Over the past couple of years, public companies have seen a sharp rise in shareholder support for environmental and social proposals and continuing focus on compensation issues extending beyond the say-on-pay vote. How companies respond to these environmental, social, and governance, or ESG issues, has become a tangible measure for investors' evaluation of a company or a business. We here are focused on the lessons we learned from the 2018 proxy season, and we are offering guidance to assist public companies as we prepare for the 2019 season. One note, sometimes this time of year feels very reactive. While this webinar is going to be focused on the upcoming proxy season, we have seen a real shift towards more proactive shareholder engagement all year long. We are planning to host a webinar in 2019 with some tips and real-life experiences on how best to do that. Our agenda today is packed, so let me briefly go through the topics that we have. First, we will have a presentation on ESG and other emerging areas that influence disclosure. The second presentation will be on the proxy statement document, actually. The third presentation will be an update on shareholder proposals. Fourth, we'll turn to executive compensation disclosure specifically. And fifth, we'll turn to the annual report disclosure specifically. Without further ado, let me introduce our first speaker, Christy Davis. Christy is a new addition to the McGuire-Woods team in Pittsburgh. She is a senior counsel and focuses her practice on corporate finance and capital markets, corporate governance, and securities compliance matters. She has experience representing issuers in public and private offerings of debt, equity, and hybrid securities, as well as securities redemptions and consent solicitations. Today, Christy will provide an update on ESG and other emerging areas that influence disclosure. Christy?
Thanks, Jill. As Jill noted, I'm going to talk to you today about environmental, social, and governance, or ESG matters, focusing primarily on their impact on disclosures. I'm also going to try and talk about a few hot topics in the ESG space that demonstrate the continued focus by institutional investors and others on ESG matters and demonstrates the importance that ESG matters have taken on. Historically, ESG matters were led by the influence of special interest groups, and typically this was driven often through the shareholder proposal process. I'm not going to spend any time on shareholder proposals because we have a presentation that focuses on those. ESG has evolved to a mainstream focus as many of the major institutional investors now integrate material ESG matters into their investment decisions, and they engage with companies throughout the years. They task companies to make disclosures and address issues. They sometimes utilize shareholder proposals, but as Jill mentioned, they engage with companies throughout the year. I'm going to focus on the disclosure aspect of that. And I know I said I was going to advance the slides, Jill, so I can take those over now. A couple of the institutional investors, I apologize, a couple of the institutional investors who have really gotten some predominant press are on if you're following along on the slides, the next screen. I'm not going to read the quotes, but BlackRock has an investment statement that they indicate they now incorporate material, environmental, social, and governance information into their investment decisions. Vanguard introduced an investment stewardship annual report, and they evaluate whether and where environmental, social, or political risks pose a challenge to the company's long-term performance. State Street is also in the game, helping investment advisors overcome the challenges of adopting an ESG investment strategy. And one of the things that they say is a challenge is the exact topic we're talking about, the lack of good, consistent quality disclosure and understanding what ESG disclosures really mean. There were also a large group of institutional investors who represent $5 trillion of assets under management who petitioned the SEC for rulemaking on a comprehensive framework on ESG matters. Political interest is also growing. I'm not going to spend a lot of time on this, but Senator Mark Warner of Virginia sent a letter to the GAO asking for a cost-benefit study of the SEC promulgating ESG disclosure regulations, and the Center for American Progress also asked the SEC to commit to ESG transparency. They wanted explicit line item disclosures, and they suggested that a great starting point would be places where investors are now clamoring for disclosures, such as employee pay, diversity, climate and weather-related risks, and their voices being heard as well. The SEC itself, many of you are probably aware of this, so I won't spend much time on it. They actually raised the ESG disclosure matter in the 2016 concept release where they were looking at modernizing SK. There hasn't been any rulemaking out of this yet, but they posed 8 topics and exploratory questions. And again, we don't have time to really go through the comment letters that were received on that particular concept release in the ESG space, but even the SEC itself is looking and saying, hey, maybe investors really want this information. I don't think it was a big topic at the roundtable at all. There were much more exciting things that you'll hear about later, but it was at least on the SEC's list of things to talk about. So what does this all mean? Investors are demanding qualitative and quantitative ESG data to enable them to fully understand the risks that they face at a company from ESG matters. Check-the-box disclosures are no longer going to suffice. And one of the things when I was preparing this presentation that struck me as very interesting is over and over again I heard that they want useful, meaningful data. And then the big question is, what is that? Companies and investors both are struggling with to answer that question appropriately. So there are some emerging ESG frameworks, which a lot of you are probably familiar with, that provide the potential, and I'm going to underline the word potential, for data consistency among companies. And I list a few of those in the materials: GRI, the Task Force on Climate-Related Disclosure, SASB, which is the Sustainability Accounting Standards Board, CDP, used to be called Carbon Disclosure Project, and I'll get into a little bit of the GRI standard when I talk about the CSR. There's also a push for an integrated disclosure framework, which is even lagging behind some of these others. I think only about 14 companies used an integrated type of report in 2018. Glass Lewis also announced, gave a little bit of prevalence and support to the SASB because they announced that guidance on material ESG topics from the SASB would be integrated into their proxy research reports and voting platform, and that will be before, and I think later in the presentation there's a little bit of space about this, so I won't spend much time on it, but in advance of this 2019 proxy season, those will be incorporated into their platform. And I have a little bit of a quote there. The SASB was pretty happy about that. They like this partnering. It gives their standards some prevalence and predominance in the disclosure regime. Another thing that we're seeing grow is ESG rating firms. And this is important for those of you who aren't as familiar with these. As companies and investors continue to struggle, third-party firms are getting into the game, and they are rating companies on ESG matters. Each provider has its own rating methodology, and a company can receive a wide range of these ratings. ISS itself launched an ENS score. I believe that they started with certain companies in 2018. They have 380 questions, 8 pillars. It's a really rigorous review of ESG, and they're looking at disclosures in all the documents I'm going to talk about. The only thing I want to caution here is that if you have the opportunity to review the report that a company is putting out on you on an ESG matter, you should do so. It might be a fact check. It might be they send you a draft report. It is something that you should take a look at because they don't always understand your disclosure documents, and you should be able to make a comment and pay attention to what they're pulling out of your disclosures, and that'll help you make better disclosures going forward. So how are companies responding? They're responding through increased engagement, which is, as we mentioned, we'll have a different presentation on, disclosures in annual reports, proxy statements, corporate social responsibility reports, as well as voluntary reporting, which is the CDP, and that's the annual survey that's more based on carbon emissions. And little side note, 1,100 companies participated that in 2017, up from only 230 back in 2003. So companies are starting to participate in that type of voluntary reporting as well. The type of increased annual report disclosures you'll see are, your traditional description of business, MD&A. If these items are material, you probably would have talked about them anyway. The big place where we're seeing much more disclosure is the proxy statement. Adding sections on diversity, political spending, human capital management, and Labrador actually cited statistics that for the 2018 proxy season, 37% of proxy statements actually included an ESG section. 6% used graphics there. Interesting quote that I talk about at the bottom of this slide. KPMG, they do, as many people do, extensive reports, more than we can read, on the proxy season. And the 2018 proxy season indicated that the proxy is becoming a way of companies telling their story. And where we're really seeing this is in the environmental, social, and governance space. It's no longer just a mandated disclosure document. We're not really just telling the compensation story in the CD&A. We're telling a story about the company and their environmental, social, and governance paradigm. Companies are also responding in CSR reports. They've grown. About 80% of companies now do them. I think I found an updated statistic for 2018. It was down to 78%. The quality and quantity of data in CSR reports is expanding, and this is where we get into that some of that consistent reporting. 2/3 of reporting companies are now using the GRI framework when they put together their corporate social responsibility reports, and that lends to some comparability across those reports, which is probably a good thing. Companies are also doing what's called a materiality assessment, where you engage a third-party firm and they help you identify the material ESG issues that your investors and constituencies want to hear about in the corporate social responsibility report. And I'm not sure my slides, okay. So what does this all mean to you? And I'm going to try and go through this pretty quickly, but as published documents expand, disclosures related to ESG matters create disclosure risk. Data collection and review of these disclosures are often done outside of the disclosure controls framework, and we don't see the rigor, particularly if they're in a proxy statement or a corporate social responsibility report or the CDP report, which is often being prepared by somebody in the environmental department. So it could be accumulated, the data is accumulated by persons who aren't familiar with the financial reporting process. It's coming out of different systems, And this can lead to the potential for inconsistent disclosures of information that you might think should be the same in two different reports, like your 10K and your corporate social responsibility report. So what does this mean? What should you think about? Companies should take a step back and think about enhancing, if you have some systems, if you don't have much of a rigorous process at all around your CSR report particularly, or the additional proxy disclosures, you should think about designing and enhancing your systems. And a really important part of that is really just review by the right group of people, which could mean the finance team should look at the financial disclosures that find their way into the CSR report. The legal department, your disclosure lawyers, should really be looking at your CSR report. They should be looking at the CDP. Even if they can't comment on the emissions, there's a section in that CDP report that talks about risk mitigation and risk management. And a lot of people are now starting to put discussion of risk management from their 10K into the CDP project, and you really want a disclosure lawyer to take a look at that. Another aspect of disclosure related to ESG matters is the clamoring for institutional investors to see board engagement. One of the things Vanguard, again, in the stewardship report that I mentioned earlier, talks about is that they're seeing a consensus formed, and that consensus is that they want the appropriate oversight by senior management and boards of directors of ESG matters. I think I apologize, I didn't advance the slide again. You see this repeated in a lot of the various surveys that I've had the pleasure of reading and preparing for the presentation. And what they want is to know that the board is concerned and engaged in the ESG space. What we're seeing as an offshoot of this is expanded charter disclosures or corporate governance guideline disclosures about what type of board oversight there is on ESG matters. Some of the details that investors are asking for is that boards make sure that management identifies material ESG issues and they develop short and long-term plans for handling those issues, which would be typical board oversight activities. And there may be things that aren't necessarily material to business strategy or linked to business strategy, but a board should still oversee them because they propose the possibility of material risks to the company out of an ESG matter, such as perhaps a reputational risk. That was a lot. I went through it pretty quickly. I had a pretty meaty topic, so I'm going to turn now to some of the ESG topics that are of considerable focus, and I'm going to go through them fairly quickly. But board diversity, we've all heard a lot about board diversity. It's continuing to gain traction. It's continuing to be a focus. Gender particularly, there's evidence that boards have been responsive. Hearing this, some Heidrick and Struggles statistics on this is that 38% of the newly appointed independent board seats in 2017 were in fact women, and they project that at least in terms of new appointments, there could be parity with men in 2025. That is a little bit more positive than the GAO study back in 2016 that said absolute parity of women and men on boards would take 40 years for corporate America to reach. So as a result, what we're seeing is some legislation, primarily non-U.S. European countries, mostly, have already legislated gender diversity on boards. California has followed suit by introducing a bill that would put one woman on a board of directors in 2019. By 2021, if a board's 5, 2 female directors, or 6 or more, and there would be 3 female directors. A lot of confusion about the board. It says if you're based in California, is this principal executive office? There are a lot of estimates out there about what this really means. 377 Russell 3000 companies are actually supposedly based in California. Only 72 companies of the, I believe this was the S&P 500 statistics, are actually headquartered and chartered in California. So there's a lot of question about what this really means and how much of an impact it would have. It may not withstand the challenge in courts. A lot of people are talking about the fact that it's based solely on gender and not other diversity factors, that it is discriminatory against men. Beyond diversity, there's a few topics that I will go through very quickly, but we are starting to see other European governance initiatives find their way into the U.S. in a variety of different ways, one of which is worker representation on boards. That was primarily, I'm going to flip to the next slide, that was primarily a German initiated action quite some time ago, all the way back in 1976, where a significant number of German companies have workers that are able to appoint up to half of their supervisory boards. UK Corporate Governance Code has come along and also has requirements for worker representation on boards through the workforce. It gives you 3 or 4 options of what to pick from, and if you don't pick from one of those, you have to explain why. What happened in the U.S. is Senator Baldwin wrote to the SEC and said they should consider this at the roundtable. They did not consider it, and we get to Elizabeth Warren's Accountable Capitalism Act, which does have as one of its actual conditions or requirements worker representation on boards. So I'll flip to that real quick. This is we could have a whole 2 hours on talking about this and what it really means. But it's basically asking U.S. corporations to look at all constituencies, employees, customers, and communities, not just shareholders, creating a United States Office of Corporations. I'm not going to read the metrics on who it would apply to, basically very large corporations. The substantive provisions would be that 40% of the membership of the board would be appointed by the employee population. It limits the ability of corporate executives to sell their stock, so it's actually stock ownership guidelines being mandated upon executives. It prohibits certain types of political contributions and expenditures if they aren't approved by shareholders and board members. And it would also permit the federal government to revoke the charter if a corporation has engaged in repeated, egregious, and illegal contact. It's viewed by most as a conversation starter, but I think the important thing is to remember that it's part of some political activity that we're seeing that's aimed at corporate power, and it's traditionally embodied in Europe outside of the U.S., and we're starting to see this type of action in the U.S., and it's gaining more predominance, and at least in terms of discussion, and bills being introduced. And it serves to remind us that, ESG matters are here to stay, and that investors and politicians are going to continue to focus on these things. And I think my key takeaways are probably self-explanatory, and I don't want to keep taking others' time. So I think that's a wrap.
We're going to jump right into my topic, which is going to be focused on the actual proxy document or proxy disclosure. The first slide here talks about the items that we're going to discuss today, so I'm not going to go through those, but if you need to look back, that's the order that I think we'll go in. The first thing we're going to talk about is evidence of the magnitude of the problem that we have right now with our proxy plumbing system. And the 2017 proxy contest between P&G and investor activist Tryon Fund is a great example, you might call it even a tragic example, of inefficiency and high dollars. Combined, the cost was $60 million, and there were millions of uncounted votes. The end result was Peltz, who was with the Tryon Fund, getting named into the board, even though he had just short of a majority. It was in a settlement. And a lot of commentary about how the share immobilization, or shares being held in street name, was the cause of uncounted votes, some double counted votes, and a lot of breaks in the chain of custody. Just to review how voting actually works now, we need to focus a little bit on DTC and CD & Company. It was 1973 that we had DTC formed in the beginning of what we call share immobilization. And at that time, there was a creation with DTC and the New York Stock Exchange working with CD & Co., and those were where the shares were going to reside. Stocks trade but never move when they're held in bulk in the name of the 250 participants at CD & Co. So when you're actually bringing in a vote for, you're soliciting votes for an annual meeting, you have DTC and CD & Co. identifying the bank and broker participants. At that time, those participants send either a proxy or a voting instruction form to their clients, which are institutions, individual investors, or respondent banks that have accounts with a participant bank. Then the respondent banks have their own clients, which may still include other banks and shareholder clients. So those proxies and voting instruction forms go right down the path, and then as votes are cast, they come right back up the chain until they reach the tabulator of the vote. So you have so many third parties involved. You have DTC, CD & Co., and then you have the actual proxy communication firms, proxy advisors, and proxy solicitors. Then you have transfer agents, vote tabulators, and inspectors. So you have a ton of votes transferring hands, and at that time you end up resulting with double voting and some lack of voting with these complexities. So what has happened since we have discovered these problems? And that we can focus on the SEC now taking a new step to being proactive. In July 14th, 2010, they released a concept release on the proxy system. They noted that it had been 30 years since the Commission had last conducted a comprehensive review of proxy voting infrastructure. Between 2010 and this past summer, 2018, not much was done. We actually had a few other roundtables that the transcripts are available on the SEC. It was interesting when I looked to find the transcript from the roundtable a couple weeks ago that you could find all these other roundtables, and it's incredibly frustrating when you see nothing was done. And in that 2010 release, there's all this commentary about how much technology has changed. And reading that now in 2018, you think, oh, you all haven't seen anything yet, because the dramatic changes between 2010, if you can remember what you were doing 8 years ago, and 2018 show even massive, massive amounts of technology being added into our infrastructure. But anyway, this past summer, on July 30th, we had the announcement of the SEC Roundtable. We also had at the SEC on September 13th an Investor Advisory Committee meeting, which is really a preamble to what the Roundtable was. The primary focus of that, and there were panels involved there, was talking about the transparency of the voting process, how to correct errors in the tabulation of proxy voting, the viability of blockchain-based voting, and then the possible revival of the universal proxy card. So it was a busy September. You had some other things that happened then. Also on September 13th, the Division of Investment Management published an update withdrawing 2 staff no-action letters. Those were for proxy advisory firms, and withdrawing the letters put into some question about the independency of the proxy advisory firms, and all of that was a lamplight to the upcoming roundtable. And to further regulation or changes in the regulation of that. Want to talk just a minute about proxy advisory firms. They are certainly under the magnifying glass. You see here that proxy advisory firms have been mandated. The SEC requires institutional investors to vote on proxy matters. It's SEC mandated right now. They are allowed to discharge this duty by relying on voting guidelines of third-party proxy advisory firms, and that's where this comes into play. There's been lots of criticism, particularly in the past year, although it goes back, certainly back in time, as to if the proxy advisory firms, mostly Glass Lewis and ISS, are having too much influence, if their recommendations are really not in the best interest of shareholders. This culminated in November 14th, which was just days before the proxy roundtable. It really put the fire there. They introduced this was introduced in the Senate Banking, Housing, and Urban Affairs Committee. There was the introduction of the new bipartisan bill was introduced from the whole Senate, the Corporate Governance Fairness Act, and that would require proxy advisors to comply with more provisions of the Investment Advisors Act, undergoing SEC staff examinations and a bunch of SEC rulemakings that would address the transparency, conflicts of interest, and investor protection. It stopped short of actually registering the proxy advisory firms, which is a hot topic right now, but as this bill goes through the how a bill becomes a law process, we might see some changes there, and the regulation arm would rest with the SEC, and as we get to the roundtable, which we're going to turn to in just a couple moments, you'll see that certainly was a hot button topic. The path of proxy progress, I talk a little bit more about that investor advisory committee meeting in the next slide. Blockchain. Blockchain is the technology behind Bitcoin. Blockchain is important because it gets rid of the intermediaries. It's the technology that was invented to replace middlemen, such as banks, with software. And in the proxy process, we have an abundance of middle men or middle people playing roles. And so when you have that, you have the perception of error at every turn. The blockchain has become a very hot topic. It was used, it has been used in a couple contests. Santander's used it, the blockchain system, for an annual meeting. In 2017, NASDAQ is pouring money into it. They've used it in Estonia, and they've used it in South Africa's Central Securities Depository as well. We also have universal proxies down there. The SEC proposed that officially in October of 2016. Mary Jo White did. What a universal proxy does is it allows shareholders to split votes like in a proxy contest. You don't just have to either vote for all of the company's slate or all of the proxy contest or the contester's slate. You could actually split your vote. The SEC commented as recently as a month ago, a staff member commented at a seminar that she didn't perceive it as on the agenda, but it sure got a lot of discussion at the roundtable. I have in here later, and I think it'll come up, but the SEC has commented that it has doubled the size of the rulemaking, and here it is actually at the bottom of this side, that they've doubled the size of the rulemaking office as a result of initiatives that are expected to come out of the proxy roundtable. So and again, I don't want to get our hopes up because in 2010 there was a roundtable as well and nothing came out of it, but there certainly seems to be new fire lit under the SEC to make some of these changes. Turning to the SEC's roundtable, you have there, for those of you who didn't listen to it, it is webcast. It has not shown back up in the archived version yet, but hopefully, or at least it had not as I checked it yesterday morning. But it was fascinating to listen to for those of you who listened to it along with me. There's a quote there on the next slide that has SEC Commissioner Kara Stein's opening remarks. I mean, it was really illuminating when they talked about the universal agreement that the current proxy regime is broken. And that was really the topic of the first panel. I'll just go through quickly a couple of the highlights of that first panel, which is the proxy voting mechanics and technology. There really was consensus about need to have accuracy in the vote count. End-to-end communication was discussed many, many times. Communication with beneficial owners of shares. Companies have really, or issuers have come out and really echoing the desire to talk to not just, NOBOs, but also OBOs. It's very difficult to have communications under the current OBO-NOBO system for issuers, and there is definite consensus among many of the players on that panel to make changes to that system and allow companies direct communication and contact with their retail shareholders. The universal proxy came up again and again, and again there's questions about how technically this would work, the details mattering, what percentage of shareholders dissidents would need to solicit, what does the layout of the proxy card look. They talked about, well, what if somebody wants to vote for these people thinking they're going to be on the company wants to put a slate out thinking it's covering the audit committee, but it would be willing to concede that person from the audit committee if this person at the dissident was voted in. And there's certainly a lot of decisions that have to be made onto how a proxy card would look. But as many panelists pointed out, we have the technology for it. It doesn't all have to be in print anymore. That brings up the inclusion of the proxy card or the voting instruction form under notice and access, which is definitely a hot button topic about putting that out electronically instead of having people right now where they have to wait. But the bottom line coming out of the actual panel on the first panel was that instead of intermediaries voting these masses of shares and having votes under and over counted and not confirmed, the use of blockchain or some other distributed ledger technology would allow for traceable shares. And so there's not a need for all these intermediaries. It would be a massive change to the system. I don't know if I'm willing to bet on the SEC adopting a massive change, but there was certainly talk or discussion about near-term steps that could be made. Routine and reliable vote confirmation could be mandated. Guidance on reconciliation, universal proxy guidance, those could be undertaken now. But I really think we're going to be looking at some big changes. Just really quickly, the last two panels at the actual roundtable, there really wasn't clear consensus. The proxy advisor systems, there was a lot of back and forth and discussion about the problems, but there wasn't clear consensus. And then we had, it was a good panel on the shareholder proposals, but I'm not going to get to that because Katie's going to discuss that in just a couple minutes. I keep clicking, okay, sorry. Oops, sorry, went too far. The next things we're going to talk about is Glass Lewis and ISS, who both came out with the proxy advisor guidelines, October 25th for Glass Lewis, and I believe it was last week or a week and a half ago for ISS. I'm not going to go through those just because we are quick on time, but if you do have a proposal or discussion with your shareholders about some of these topics that were released or discussed further on, it is important for you to look through these things because both ISS and Glass Lewis have changed their voting policies on certain things. Really, they're continuing with the trends that they've announced before about being more proactive. I'm going to move on to the evolving look of the proxy statement. This really has been covered so well by Christy, too. The proxy statement has gone from a compliance document into a marketing document. And the proactive nature of things she talked about, the key things that we're talking about engaging with your shareholders on are really coming into play in this proxy statement. And thus, it's getting filed with the SEC, and we need to be considering, as corporate lawyers, what this is and what liabilities there are for disclosing some of this information. Investors are calling for what they tagline as decision useful information, and this goes outside of the mandatory disclosure documents. The mandatory disclosure requirements. Some of this is duplicative about what Christy did, so certainly kind of read it at your leisure. Talk a little bit more about the voluntary expansion of audit committee disclosures. There's some statistics in there about new emphasis on the audit committee oversight of cybersecurity risk, as well as some other audit committee disclosures. I just want to touch on the non-GAAP numbers. You should remember that Reg G does apply to use of non-GAAP members, and while we have non-GAAP numbers, while we have seen the volume of comment letters go down, they are still above the 2015 and 2016 season levels. So you need to be looking at those financial measures if they're in the proxy. Really quick, we're going to touch on virtual meetings. This was a Glass Lewis comment, a Glass Lewis change this year, so you can see the recommendations for virtual meetings. Really, there's a group called the Best Practices Committee for Shareholder Participation in Virtual Annual Meetings, which does a great synopsis if you're thinking of having one. The key, I think, is to have a hybrid meeting where you are allowing both those appearing virtually and those appearing in person the same access, the same level of dialogue. It's important, and you won't run into an opposition from ISS or Glass Lewis that way. Turning to our next topic, and I'm sorry that we're going kind of very fast. These are very interesting topics, but I'm going to hand the computer or the microphone over to Katie DeLuca. Katie is a partner in our Richmond office, and her practice primarily focuses on similar matters as Christy and I, compliance with securities laws, mergers, acquisitions, corporate governance, securities offerings, et cetera. Today, Katie's going to provide an update on shareholder proposal trends.
Thanks, Jill. And of course, the 2018 proxy season definitely had some noteworthy developments regarding shareholder proposals. And today I'm just going to try to hit the highlights. In the interest of time, I'm also going to talk fast. And if I skip over something of interest to you, please feel free to reach out to us. First, I'm going to discuss some key trends. Then I'll discuss some new important SEC guidance on shareholder proposals that came out. And last, I will briefly discuss shareholder proposal reform, or rather the lack of it at this point. Next slide. For the second year in a row, environmental and social topics was the biggest category of shareholder proposals that we saw. A few years ago, corporate governance topics were consistently the biggest category. But for 2 years now in a row, the number of corporate governance proposals have been surpassed by the number of environmental and social proposals. We expect that trend to continue in 2019, which reflects also the similar interest from investors that both Jill and Christy talked about in this area. Political spending and lobbying proposals also remained another important category, and certainly will next year as well. One significant development that's worth pointing out is that there was an increase in the number of proposals that were submitted to issuers and then subsequently withdrawn by the proponents. And this is because more companies are engaging with shareholders on these topics, and there's also an increased willingness on both the companies and the proponents to reach a compromised position, especially regarding certain social topics such as board diversity that we saw last year. Also, the number of PX14A filings by proponents increased this year. Well, not new. The volume definitely increased. And in case you don't know what these are, they're exempt solicitation filings that a shareholder can make and that show up on an issuer's EDGAR page. And shareholder proponents are using these as a way to publicize their views on various proposals. Next slide. Also, reflecting media headlines that we're seeing lately, we saw lots of shareholder proposals on gender and diversity topics. There were also proposals on the opioid drug epidemic, gun safety, the pricing of prescription drugs, cybersecurity, and human trafficking, and we can certainly expect these topics to remain popular in 2019. Another development that I thought was surprising, and that's worth focusing on during 2018, is that there were several companies that successfully excluded shareholder proposals that sought to lower the ownership requirement for shareholders to call a special meeting. And these issuers accomplished this by submitting a management proposal that asked shareholders to ratify the company's current ownership requirement. And then they would successfully argue to the staff that the shareholder proposal should be excluded because it directly conflicts with the management proposal. Now, it's surprising that this tactic worked, considering the guidance that the staff issued a few years ago that led to the so-called dueling proposals related to proxy access. So this recent trend seems to be somewhat of a reversal of that guidance, or at least a limitation possibly of that guidance, and it's going to be interesting to see if that strategy continues to work in 2019. Regarding environmental proposals and topics that we saw during 2018, we saw many of the familiar topics that we've seen now for a few years that I've listed on the slide. Support for these proposals increased slightly during 2018, and since interest remains pretty strong, we think that we're going to continue to see this in 2019. In 2018, we actually did see a few proposals receive majority support, and I've listed those on the slide as well. Next slide. Looking specifically at board diversity proposals, which were very common last year, most were actually withdrawn and not voted on, and this was due to negotiations between the companies and the proponents and compromises that they reached. However, we expect pressure to continue from large shareholders on these issues in 2019. There were also several proposals on gender pay gap issues, most of which were also withdrawn in exchange for a commitment from the company to report on its efforts to advance gender pay equity. Regarding corporate governance proposals, there was a significant drop in proxy access proposals in 2018, and this is because many large issuers have already adopted proxy access, and the key shareholders that were pushing for proxy access have now moved on to other topics, such as various gender-related issues. Other popular proposals included ones on shareholders' right to call a special meeting, rights to act by written consent, shareholders' right to act by written consent, and also independent share proposals remain popular. I think the biggest recent news is the new guidance that the Commission released just last month in Staff Legal Bulletin 14J. SLAB 14J expands and clarifies on the guidance that was issued last year with SLAB 14I. In last year's guidance, the Commission encouraged issuers to provide in their no action letter requests where they were seeking to exclude a proposal, board analysis on certain elements to the economic relevance exception and also the ordinary business exception, certain elements that involve difficult judgment calls. However, initial attempts at applying the staff's guidance were primarily unsuccessful. Of the first 30 or so no action letter requests that included this board analysis, all but one failed. So many began to conclude that the benefit of providing this board analysis was actually somewhat limited. So now, in the interest of time, I'm going to skip forward a few slides. I'll tell you which one. A skip? One more. Okay. So in looking at the two exemptions, so the last two slides I skipped actually outlined the standards for those two specific exemptions that are at issue in the SLABs, and it lists the specific elements that the staff asks issuers to provide board analysis on. But primarily with the overall, where we ended up as a result was that the board was asked to help analyze, certain aspects of those two exclusions that involve difficult judgment calls. For the economic relevance exception, it's how significant the topic is to the company's business. And for the ordinary business exception, it's whether or not the particular policy issue that's at stake transcends ordinary business and is therefore an appropriate topic for shareholders to consider. As I said earlier, the issuers that tried to use this board analysis were not successful. So last month, the staff issued SLAB 14J, which tries to address some of the concerns that were developed over the usefulness of this board analysis. Next slide. In SLAB 14J, the Commission first reiterates that in order to be useful, the no action letter needs to include well-developed discussion of the board's analysis and provide in sufficient detail the specific substantive factors that the board considered in arriving at its conclusions. The Commission also included in the SLAB a list of non-exhaustive items which might be factors that the board could consider and include in its analysis, which I've also listed on the slide. And these factors actually provide a really useful roadmap for an issuer who's trying to develop the appropriate board analysis and can likely develop better support for an argument that the proposal should be excluded. Next slide. In SLAB 14J, the Commission also reminds issuers that a proposal may be an appropriate subject matter for a shareholder vote, but it still may be excludable if it is attempting to micromanage the company. Now, this is important because over the past several years, very few micromanagement arguments made to the staff have been successful. So in SLAB 14J, the staff, the SEC seems to be signaling that these arguments may be viewed more favorably going forward. And during 2018, there was actually an uptick in the number of micromanagement proposals that were successful. So it's going to be interesting to see if that trend continues in 2019. Next slide. SLAB 14J also clarified that the absence of board analysis will not create a presumption against exclusion, and also because the considerations involve specific facts and circumstances, a proposal that is excludable for one company may not be excludable for another. And also the staff noted that substantive governance topics are almost always significantly related to all companies. So in other words, don't bother trying to argue the opposite. Next slide. So what are some practical tips for 2019? First, issuers should consider updating the board on its role in providing analysis on the excludability of certain shareholder proposals. And this is especially true for issuers that receive shareholder proposals on a regular basis. Also, you may want to consider consider the board meeting calendar, and if it's appropriate to add shareholder proposals as an annual topic at meetings that are hopefully carefully timed to fall shortly after the deadline for shareholder proposal submissions. And also in any related board materials that are prepared for helping the board provide such analysis, they should probably outline the specific applicable factors that are suggested in SLAB 14J and how those factors apply to the company and the specific proposal. Also, issuers should keep in mind the micromanagement argument, which does not require board analysis, since this exemption seems to have some new life, so to speak. And companies should also consider negotiating with proponents of shareholder proposals, and ask if they can actually meet them part way, because that seems to be more successful these days. Also, issuers should monitor their exempt solicitation filings that may show up on their EDGAR page that shareholders are making, and they should look at those for false and misleading statements, because if they find any, they may want to try to raise those with the SEC as a problem. Next slide. Finally, regarding shareholder proposal reform, the true headline is that it looks like meaningful reform is going to be difficult to accomplish. It is still a priority for Chairman Clayton, but for example, the reforms that were included in the initial draft of the Choice Act were stripped out before the bill was passed. And even though the SEC is still under pressure to amend its rules, there's also significant opposition from certain large investors, which will likely make changes difficult. So we'll have to wait and see what happens, but I've been wrong on that before. Thanks, Jill.
Great, Katie. The SEC's got a lot of other stuff on its agenda, too. So turning to our next presenter on our next slide, we'll hear from Will Tice, who's a partner in our firm's Washington, D.C. office, and he's going to provide an update on executive compensation disclosure. Will is the co-chair of the firm's Employee Benefits and Executive Compensation Group. Thanks, Will.
Great. Thanks, Jill. It's going to be a pretty short presentation, as there have not been many significant developments this year in terms of executive compensation disclosures, but there are a few items worth highlighting as we head into 2019. The first is CEO pay ratio. As we all know, 2018 was the first year for pay ratio disclosures. This year, the main thing companies will need to decide is whether they can and should use the same median employee that they used last year, or whether they should redetermine who their median employee is. The SEC rules allow you to use the same median employee for up to 3 years, as long as you reasonably believe that there haven't been any changes to the employee population or compensation arrangements that would result in a significant change in the ratio. Obviously, the difficulty there is going to be in deciding what changes to your employees or your compensation arrangements would be significant enough to impact the ratio. If you've had a major merger or divestiture, you obviously need to take that into account, but short of that, there's going to be a lot of gray area. If practicable, you may want to consider doing a rough check of where your existing median employee falls based on your 2019 data. Once you have that, just make sure you're in the right ballpark. Another trend for 2019 is increased focus on director compensation disclosures. ISS issued guidance last year that indicated that they're going to begin recommending no votes against board members if there's been a pattern of quote-unquote excessive director pay. In response to this, companies are being advised to examine and, if necessary, beef up their director compensation disclosures. In particular, it may make sense to ask your outside compensation consultant to benchmark your director pay if you haven't done that recently. If your director pay is sort of at risk of being deemed excessive, then it probably would make sense to attempt to explain or justify the reasons for that in your proxy this year as well. 162M, I'm just going to hit very quickly. The main point here is to recognize that there were significant changes to 162M last year as a result of the Tax Reform Act. In particular, the performance-based compensation exemption was repealed, and as a result of that, you want to review your 162M related disclosures in your CD&A just to make sure that they reflect those changes. So finally, just a word on say on pay and institutional proxy advisors. There weren't any big earth-shattering changes this year. The ISS guidelines, as Jill mentioned earlier, came out last week. and we're very minimal in terms of executive compensation. There's only one really worth mentioning. It's on the slide here relating to economic value added. ISS is going to start to consider EVA as in addition to TSR and GAAP measures when they're assessing the relationship between CEO pay and company performance starting this year. Glass Lewis made a few more substantive changes to its executive comp guidelines for 2019, which are listed on the slide there. Again, none are big surprises, but they are worth taking a look at, especially if you're a company who's had any issues with getting SAM pay approved by Glass Lewis in the past. That's it for me, Jill. I will turn it back over to you.
Great. Thanks, Will. We've got about 7 minutes left in our final topic. We're going to turn to Janie Sellers, who's a partner in our Richmond and Charlotte offices, and she's going to talk about annual reporting, disclosures for 2018 and beyond.
Thanks, Jill, and happy to be here today to bring up the final segment. We are going to be looking, and I realize that now I need to advance the slides, sorry, looking at 10Ks, and I'm starting with what's new for 10Ks this year based on rule changes. And I would say that there's not a lot, but actually there are a lot of small changes. The cover page is different, so people will be able to tell right away if you updated your rules check, if you didn't get those two little items changed. One having to do with an instruction about smaller reporting companies and the other removing some language about XBRL website postings. The SEC in the summer adopted a lot of disclosure simplification changes working under the FAST Act, and they became effective at the beginning of November. And I'll go through a few, but not very many of them, but a lot of them will change portions of your business discussion. They move things around or eliminate redundancies or eliminate information that can be easily gotten from other sources. One thing to keep in mind is that some of the changes move information from the actual body of the 10K into financial statement footnotes, which then adds them to the audit review category and internal controls and XBRL tagging, and also affects the availability of forward-looking statement disclaimers applying to those from outside the footnotes. You can still use your bespeaks caution and temper your forward-looking statements in footnotes, or you can just not put forward-looking statements in your footnotes. Some of the amendments that will be noticeable is that the listed companies are no longer required to disclose their high and low stock prices. They do need to disclose their trading symbol, but then I guess the SEC has determined that you can go to many other sources and actually look up those stock prices if you'd like to see them. The dividend frequency and amount disclosures, which were in the body of the 10K in addition to the footnotes, are now moved to footnotes, and other disclosures about dividend restrictions are consolidated in the footnotes. The segment and geographical financial information that used to be required in the business description has been eliminated but retained in the financial statements, and frankly, most of the time people just cross-reference the ones that were in the footnotes anyway, so you've eliminated your cross-reference requirement. Another thing that's not technically a 10K change but may affect some people's 10Ks is for prospectuses, the disclosure of the ratio of earnings to fixed charges has been eliminated as a required item on the theory that it's easy enough to figure that out yourself. However, in the past, some registrants who were frequent issuers included as an exhibit to their 10K and 10Qs the quarterly and annual computations of those ratios, and now that exhibit can be eliminated. That's really it in the category of what's actually new, but I thought I'd take a minute to remind you of some things that are fairly new that came up earlier this year. In very early 2018, there was a staff accounting bulletin that provided guidance on disclosures relating to the impact of tax reform that came in December of 2017. And while registrants have been making disclosures throughout the year, experience with tax reform has been gathered over the course of the year So consideration should be given in the 10K as to whether there are changes that should be made in those previous disclosures based on what happened on the full year. Also, last February, the SEC itself, the Commission, not the staff, published guidance on disclosure requirements applicable to cybersecurity risks and incidents. They did not adopt any new rules. They merely, or I shouldn't say merely, they pointedly focused attention on the current disclosure requirements that may be applicable in this area, risk factors, legal proceedings, MD&A. It could even fit in the business description if you are in a regulated business where cyber readiness is part of the regulatory scheme. The other thing that they pointed out is that you really need to make sure that your disclosure controls are reaching these topics. And to, I guess, emphasize that, in April, the SEC announced that the former Yahoo Inc. had agreed to pay a $35 million penalty in connection with a failure to disclose a large data breach. The data breach occurred in 2014. It wasn't disclosed until 2016 in the context of an acquisition, and it actually affected the pricing in that transaction. The SEC's focus appeared to have been less on the lack of disclosure about the breach itself, but more on the failure to have disclosure controls that to bring that item to the fore. Why it would take 2 years seems a little strange, even though we all know that those cyber incidents, sometimes everything is not readily apparent at the beginning. In the other category of what's fairly new, keep in mind exhibit hyperlinks, and your disclosure controls should include testing those links to be sure they're actually working. And then in the category of what never gets old but can always be new is updating your risk factors. And hot topics for this year would include cybersecurity, Brexit, LIBOR going away in 2021, immigration issues, tariffs, sanctions, climate change. And listening to Katie, I think I also added to my list opioid issues for companies in those business, gun safety, human trafficking if you're in the hotel business. I mean, there are a myriad of issues out there to be considered for risk factors. I was looking at the Harvard Business Review that just came out, and there was a little squib in the back about the biggest issues that leaders face right now is the global political environment, which is an interesting thing to think about, and how it and related topics can affect you. Some of the other risk topics that were highlighted in that magazine were the topic of working older, people not retiring because they need to keep working or they want to keep working, and how do you manage that workforce, managing #MeToo issues, activist CEOs or activist companies that take positions that alienate customers or suppliers. Is that a risk for your company? I'm not sure that calling out the CEO as a risk factor is the best idea, but for some companies, they might need to acknowledge that. Cybersecurity, and then the related issue of personal data collection. Also in the category of what never gets old, and this was mentioned in the context of the proxy statement, is non-GAAP measures and minding your non-GAAP measures. The accounting staff at the SEC has also focused on having the audit committee involved in reviewing non-GAAP disclosures and whether they need to be made and are appropriately made and are reliable. And then in terms of what's coming up, that's not so much for this year, but there are going to be changes in the auditor reports. Already in effect, starting this past year, the report has to disclose when the auditor first begins serving consecutive years, and that may be one of the reasons for the increased voluntary disclosures on the committee's rationale for selecting the same auditors. The big issue coming up next year for accelerated filers and 2020 for other filers is that the audit report has to disclose expressly matters the auditor considers to be critical audit matters, or disclose that there weren't any. And the current year recommendation is to plan ahead and discuss potential CAMs with your auditors and the audit committee now so that you're ready next year and the company's disclosures can be synced up. And then last, the questionnaires. What's new? Nothing. So we do have the McGuire-Woods updated questionnaires. They will be available through lawyers here if you want to get in touch with us. And for the most part, what we did was change the dates. We did try to improve on our plain English a little bit, but the other thing that seems to be happening with D&O questionnaires is that instead of having them focus strictly on the rules themselves, they are also a useful tool for gathering other updated and additional information about your directors and officers instead of having to bother them on multiple occasions. And while gathering that information might not lead to any new current disclosures, it might be useful for you in terms of early awareness of potential issues. And that wraps it up on the 10K.
Great. Thank you, Janie. Thanks to all of our presenters for today's program, and special thanks to everyone in the audience who joined us, and we hope you found it insightful. In closing, if we did not address your question during the call, we can follow up with you via email, or if you have a new question, please feel free to contact us anytime with questions or comments. We look forward to seeing you at our next presentation. We haven't specifically scheduled it at this time, but we're expecting it to occur towards the end of January. On behalf of McGuire-Woods, thank you all for joining us today, and we hope everyone has a great end to 2018. Happy New Year and happy holidays to all of you from McGuire-Woods.